Okay, so welcome to the presentation. I've done this presentation before at the ACT. I've slightly changed it. Before it was capital-intensive sectors. So today it's industrial sector and the wealth economics and the wealth of nations. It's just a theme. Okay, it's focusing on industrial sector. So anything you can think of that is industrial or high capex, infrastructure, big capital projects will fall into this pretty much. So about me and the company, my name's Paolo. I run a company called Mercurio Capital, which is basically a credit broker. So we broker debt for SMEs in the UK. And we also do some advisory typically on anything which is capital intensive, so energy projects, infrastructure. So energy projects and infrastructure, water treatment, anything which is high capex will get my interest. Okay, so let's start. I'm going to cover the presentation itself. It's about 20 minutes, 15-20 minutes. We're going to do a macro overview of industrial production, different countries. Then we're going to go into capital-intensive basic modeling, what it is, how it works. Then we're going to go slightly more technical into cost of equity, which is the real where the money is. Is slightly technical. I don't think that's a problem here because you're all technical. So I think it shouldn't be an issue for you. And that's it. Conclusion and Q&A. Okay. So feel free to interrupt, ask anything if you want. Okay. So first of all, I'm going to ask you to have a look at these statements, and just make a mental note now if you agree or you disagree with these statements. So natural resources make a country rich. Capital-intensive sectors, that means high capex, are old-fashioned. It's old-fashioned to deal with heavy industry, for instance. Investors can make more money in digital economy than in heavy industry. Germany is very successful with the industrial and manufacturing sector, and the UK economy will never have a strong industrial sector. Okay, so make a mental note now. We're going to go through the presentation, then we're going to go back to these statements and see if your mental notes changed. Okay, so some numbers. UK auto industry exports more cars, this is from this year, than in imports. Last time this happened, any ideas?
1964.
Close, 1976. 1976, okay. UK place in world industrial production in 1895. I picked 1895 because it peaked, it was first. So what's the position today? Any ideas? 24th? 10th. That's good. It's 9th. Which is good. Some people will go, it's 69th, 94th out of 150 countries. It's 9th. It's a good position. Labor force in manufacturing in China, 100 million. In the UK? Any numbers, any ideas?
25
million? 2.3 million. Okay, it's a lot of people. In the sector, and typically it's not in the southeast. It's certainly not in London, but it's still a lot of people. Okay, so UK industrial success stories. Come on.
Dyson.
Okay, in sector. Should be one. I think pretty obvious. That's one. Okay. I think, the most obvious for me would be the auto industry. Okay. There's others. Aerospace. So, food and drink, pharmaceuticals, semiconductors. Most people don't know this, but it's one of the UK is one of the biggest producers in semiconductors in the world, in aerospace and defense. Okay. And these are all industrial. So, sometimes when when the word industrial is referred, people think of textile and very old concepts. This is industrial, and this is some of these industries are very competitive. Okay, so any niche can grow. Semiconductors is a niche.
What is semiconductors? I don't know what it is.
It's what goes in the computers.
Chip. Chips, okay.
What goes in computers. So, room to grow. Any niche can be a big.
Can I just ask why you think that the UK maintains its prominence with a lower cost base in the Far East, like in China? Do you think it's because of perhaps universities and standard of education in the UK?
I think we're gonna come back. I think the next slide. No, in 2 slides. I think there's going to be something for you. But if the presentation doesn't answer the question, we'll come back to you at the end, okay? Because I think that's a very wide question. And one thing about and I think the presentation introduces that or raises awareness for that. The industrial sector is highly complex. Okay, so you've got a lot of moving parts, So it's difficult to pin where the success or the failure came from. Okay, sometimes it's just so many moving parts that it's very difficult to say whether it went well, it went pear-shaped, how, why. So that's something that I wanted to transmit, and hence I think the question is is very broad. So there could be several answers that could be correct. So if you don't mind, we'll come back to that at the end, okay? So comparison, this is macro. Comparison between Germany, which is the gold standard today in industrial sort of sector. Any Germans here? Feel free. I'm a German speaker. I'm a friend. Any Germans? No Germans. Okay, fine. So comparison between the Germans and the UK industrial sector as weight on GDP. Okay, that's the only measure we'll look at. So Germany's industrial sector weight on GDP is 29.1. 25 is industry and 4% is construction. The UK is 21% overall, which is 14.6 industry and 6.4 construction. Okay, so putting construction aside, Germany is double the size in weight GDP. Okay, it's nearly double. So this difference in numbers, just as a to play a bit with the numbers, this would mean about 200 billion pounds in extra GDP per year, every year, about 600,000 jobs extra, and it would take the UK from the world GDP sort of league from 6th, which is currently to 5th. Okay, just put some of these numbers into perspective. So let's go into fact or fiction. Everything is produced in China. Nothing is produced in the UK. Fact or fiction? Fiction. Anyone for fact? Okay, no one for fact. This is a tricky one because some of the industrial, take something like an iPhone or an end consumer product that people buy. So they buy this, but this may have a supply chain which is absolutely, gigantic to get to this. And some of the complex electronic products, like the mobile phones, the TVs, etc., or even the automotive industry, they have supply chains that last for miles. So sometimes you have UK suppliers, very niche within the supply chain. It's just that whatever they produce, it's buried in an end consumer product with final assembly in China or somewhere else, but mostly in China. So you don't see it. So people say, oh, everything's produced in China. So this is a bit of a fact and fiction. Okay, it's a tricky one. Industrial units are big polluters of the environment. Fact or fiction? we're among friends, so.
It depends which industry.
Okay, I go for fact, okay? And the reason why I go for fact is the potential. So industrial units have the potential to be big polluters. They may not be if they choose to have a look at their wastage, whatever their raw commodities they're using, whatever energy they're using. And I don't know if I don't know how many of you come from industrial companies or? Okay, so how many of you from software companies? Services sector? Most? Construction? Okay, so mostly it's services. I consulted to typically heavy industry a lot, and one of the things that I tend to do is to have, if you ever consult to a big industrial production unit, one thing you always do is you measure how much they, for instance, if they consume electricity or if they consume natural gas, take a look at the closest town, okay, near the industrial park, and compare how much the factory uses, and compare how much the town uses. So I've as a rule of thumb, I've consulted most heavy industrial model or companies that I've dealt with consume as much electricity, as much natural gas, as much diesel as small towns. Okay, so there is a potential for pollution. Hence, you need to be careful with this. It is a fact that heavy industry has to be very, very attentive, regarding environment. Okay. EU red tape hinders and limits UK businesses. Fact or fiction? Fact. Fiction. Fiction. Okay. So the manufacturers organization, which is they represent, I don't know if any of you know the manufacturers organization, EEF. Who else was in industry? Who else was in industry on this side? Someone else. But so basically, the manufacturers organization, they lobby and campaign and represent the 14.8% industrial sector in the UK. Okay, and their manifesto includes campaigning to stay in the EU. Okay, so I know that 14.8% is not, it's not 30%, it's not 50%, but it's still, it's still a lot of money and a lot of people employed, and they're campaigning to stay in the EU. Okay. Public cash help doesn't make a difference when financing industrial high-risk projects. Fact or fiction? Any opinions? Any votes? Fiction? Okay. I've just taken one measure, which is public. It's on the it's underneath the. I can't see it, but by the way, if any of you wants this presentation at the end, I'll publish on my website. But if you want it, I'll just give me your email. And I'll send it. You can't see because of the screen, but there's a link here for the gov.uk website where this was taken. So the government, the Business Finance Partnership Programme has helped create £5 of lending for each £1 of government guarantee. So there is a certain leverage that government cash puts into the economy when they guarantee a project. Okay. There is a financial resources competition between different sectors of the economy. Fact or fiction? So there's different sectors. So construction, services, heavy industry, real estate, banking. Are they all competing for resources? Fact or fiction? Fact. So as an example, the finance and construction industries, they tend to be somewhat linked because finance will seek, everything else being equal, lower risk. And they will, if they have the choice of real estate and something which is not guaranteed, like a business project, so a high capex business project, they will tend to go for real estate. Okay. And continental style of capitalism provides better ecosystem for longer term industrial investments. I don't know if you. So the rationale behind this question is with Germany's success in manufacturing, one of the statements was that because they tend to have private companies, so their companies don't tend to be public, which is a sort of Germany is sort of the European master of private style of capitalism. It provides a longer term perspective for bigger investments because private shareholders are not pressed for returns. They don't have a shareholder every quarter going, where's my dividend or where's my return? Okay, so this is the rationale behind the question. So continental style of capitalism, Anglo-Saxon style of capitalism. Fact or fiction? Okay, it's I don't know if it's a fact or fiction, but so the Anglo-Saxon style of capitalism has led industrial production. Oh, it doesn't. It's a bit down, but so it says Anglo-Saxon style of capitalism led industrial production for most of the last century, through the UK and the US. So now Germany is ahead. So people are saying, well, it's because of the continental style of capitalism. Well, it's not been the case before. So it's not really a a case. So let's go into capital intensive, which is high capex. That's all it means, high capex. High capex is high initial investment, as I'm sure you all know, basics. So high capex, if you see the pictures, so that's logistics, heavy industry, that's probably distribution. This is software, finance. Finance is low capex because of leverage. Okay. And Guinness, which is brand management. Okay, so this is sort of light capex. That's high capex. High capex, you can have several combinations, but typically you have high capex, low opex, so high initial investment, low operating cash or investment needs, or you can have low capex and high opex, or any combination of these two. Okay. So when high capital intensive sectors are mentioned, typically there are two risks that immediately come up. One is country risk, and the other one is a liquidity premium. Because if you think about heavy industry, it's not easy to change the business model. So if you have software, and a company is writing software, and for whatever reason that particular software doesn't sell, they just start writing new software overnight. You can't do that with heavy industry or anything which is capital intensive. Okay. So let's look at how to deal, and this is just an opinion. Okay, this is just one of the ways that I do. It's nothing to do with your exam, or nothing to do with the way that your companies do things. Okay, it's just one opinion. So liquidity premium, we just take the square root to payback and or the break even in years. That's it. It's very simple. So you're going to have a payback in 2 years or 5 years. You just take the square root, which is 5, and add that to your cost of capital. Okay. Comma. If it's too much, adjust. Okay, so if your payback is, for instance, 2 years, you're not going to add 50%, right? So, or whatever number it is. So if the number is too high, you adjust. You always, this is just a model. You go and look at specific projects, specific companies in a la carte basis. Country risk premiums, I tend to use two, which is the Economist Intelligence Unit and the Standard & Poor's sovereign 10-year yields. You can choose other. I tend to use these two. Okay. So what are the biggest risks and the biggest strength of capital intensive? So the biggest risk is if you typically capital projects go through licensing, build, and operation. The issue is with some projects you may be years and years away from operation. So you may be doing the investment today or doing the analysis today and be sort of 7 years into operation. The problem is you need to model that in cost of equity and capital structure. Okay. The issue is you don't know what's going to happen in the next 7 years or 8 years or 5 years, and most capital projects, they run the most likely suspect for a capital project going into issues or problems is the financial economics up to operation or during operation go under your benchmark. Okay, so you may even have an offtake. So you maybe have a way out in 5 years, but in the meantime, it dips below your benchmark. That's a problem. Okay. The biggest strength is when you're in business, not many people can match up. Because once a heavy and capital intensive unit or model is in operation, it becomes difficult for others to come in because they will have to do whatever you've done plus the barriers of entry. It's an added premium. Okay. So project finance is a typical industrial financial design. So the project finance. Any of you from project finance background? Nope. Okay. So project finance is basically where the project is the guarantee. Okay. Not the balance sheet of the company or the director's equity. Okay, so it's a project, and they're typically used for infrastructure and energy projects where the government is the off-taker or the guarantor. How do you lock the risk? So income stream futures, if you have any, for commodities, for instance, interest rate swaps, and currency forwards. So when if you have currency exposure. So if you have a big project over 10 years, 15 years, you have to lock all these as much as possible, as much as you can. Okay, so that's a typical project finance layout. Typical the offtake contracts or the buying contracts can be very long term. Okay, it can be a couple of years, it can be 20, 25, 30 years. Okay, so let's look at cost of equity. What's cost of equity? You've just gone through the CFF. Okay, cost of equity is the return needed to keep the equity in the company. Okay, it's the opportunity cost, the economic choice of having the money into your company rather than anywhere else. There are two. There's you can look at from an intrinsic risk and a non-controllable external risk, which you don't control. The main challenges with equity is it's not a cash cost. It's not an accounting cost. So you don't go to a balance sheet or a P&L statement and look at cost of equity X, Y, Z. It's not like debt. That's the first problem. Okay, it's invisible, and sometimes it's even for for people that are in the business, in financial or accounting and finance. Sometimes this becomes slightly challenging. It's not a cash cost. It's nowhere to be seen. To add, it can't be measured directly, so you have to measure it indirectly. You have to go. It's like watching a mirror. Okay, so either through market multiples, quants, benchmarking, or ungeared beta, as Mark has mentioned. And to add to the challenge, it's for private companies, it's even more difficult to measure because there's no pricing. Okay, there's no daily quote. So you benchmark, you use you can use M&A tables, you can use history, you can use private equity, but for the vast majority of the of SMEs, there isn't a cost of equity number. Okay. So these are the challenges. However, and the reason why I'm focusing on this is because this is where the money is. Cost of equity is cash return for shareholders. Okay, So it should have some attention, and it's the trickiest bit to model in any finance scenario, let alone capital intensive or heavy industry, where you may have many years ahead of you without any liquidity. You may be a decade away from liquidity. Okay, so this is I think the slide where slightly it's probably the most technical, but I think if I can give you some insight on how I deal with this, I think if you take one or two concepts away, I think I'll be happy. So, what's your biggest challenge as a financial financial person within your company? I believe that what you should be doing is trying to lower your cost of equity in terms of cost of equity. So, as if you have a typical project over a couple of years, as the project evolves, typically the cost of equity tends to be lower. That's what you want. So if you go from the extremes of seed, very high cost of equity. Seed capital, anyone familiar with seed capital? Right? So seed capital will be, for instance, a uni spin-off. Okay? So no cash. They may be spending years in research and development, and you don't have an exit in terms of a product. So there's a lot of risk. So that demands huge returns in equity, required returns in equity. These numbers are these are my numbers, but they're fairly industry standard. So 60% for seed, 60% a year for seed. Startup about 40 to 35 early growth, then it goes to 20. So, and how does this get lower? It gets lower by events. It's not a nice straight line going down. It's events. So, for instance, you launch a product, and it's good response from the market. That's an event. Your cost of equity goes right down. In typical capital projects, that tends to be with the beginning of operations. When a sort of an energy wind farm or mini hydro becomes operational, that the risk just drops right down. The cost of equity from the cost of equity perspective. So it's events. You're targeting events. Okay. Why is this so important? Because so if at the bottom here, I just wanted to demonstrate a pure financial dynamic, which is time. So if you start with a present value of 100 and you compound for 4 years at 20, you'll have a future value of 207. If the risk drops, so this discount rate or compounding rate or rate of return is your cost of equity. If that number becomes lower, you will make more money. As in, your risk will be lower. Therefore, your discount rate will be lower. Therefore, your NPV will be higher. Okay. As a future value, it's lower, obviously, because there's less compounding. So if you do the opposite, which is I've got this FV, these cash flows, etc., and you bring it to NPV, the lower the discount rate, the lower the risk, the lower the cost of equity, the more money you will make. So the higher the NPV. Okay. And the reason why this is important in terms of capital projects is you may be many years away from your exit, your liquidity, even your operation. So and time is a purely financial dynamic. And this is one of the reasons why capital-intensive projects are very, not many people like them, because there's a lot of uncertainty, and most people are not that happy with dealing with uncertainty. So this is the biggest challenge. So you've got a lot of purely financial dynamics, such as time and compounding, acting on your project, whilst you still, as a company, dealing with all the will this project make money? Will this, will the product be successful? Will, the operations be run smoothly? So you're thinking about, as a company, you're thinking about all these challenges, and then you've got all these purely financial, very virtual and very cryptic, purely financial dynamics at work that will that if you dismiss them, you may end up with no project. Okay, so this is where the corporate finance really acts, and it's part. And whenever, out of my personal experience, most operational managers and CEOs and CFOs, they don't see so much the financial. Okay, they want instant access to capital at typically the lowest cost possible. They don't do the equity. They don't look at equity modeling. So then, they're surprised why the project doesn't go ahead for years sometimes. And then the rationale, the mechanics are here. It's all financial. Okay, and this is good for any project. It's just that in capital intensive, it's crucial. It's absolutely crucial. Okay.
In terms of, sorry, just into debt then, so looking at those events, at what point does debt, in capital intensive industry, when does debt become a viable source of finance?
Well, if it's project finance, it should be instantaneously. So whenever you have a project, you lock the project in an SPV, and whatever. So depending on the risk, depending on several factors, you may be able to raise debt in, let's say, 50-50 as an example. So you bring 50% equity, there's a match, 50% debt from some bank. So that's project finance. If it's a typical business norm, so not capital intensive linked, it would be maybe here. Okay, so you can't do, please do not fund any seed or startup with debt. Okay, please don't do that, because it's, debt is there because there should be cash flows. Okay, so whenever there are cash flows, fine. Okay, so if you're thinking of starting if you're thinking of starting a company, do not go and mortgage your house or take on debt, because that's a really bad idea. Just take on just fund with equity. Equity will take you up to at least here. Okay. So does that answer the question?
It does, yeah. I'm just thinking, if you're trying to optimise your WACC, presumably, you want to introduce debt as soon as possible, and that presumably is as soon as you get cash flows. So.
Yes. Well, yes, and as soon as you get the balance right between the cash flows and the investment, because, I think in any situation, if you're growing very quickly, so if you're early stage, there should be investments still, depending on specifics, obviously, but typically early stage, you're still going through a lot of investments, so you may have to match that. So the cash flows, if you choose to use the cash flows to pay debt, you may be a bit locked if you need to invest, okay, because the money is allocated to debt service. Okay, does that answer? Okay, good. So putting this in a sort of a map that you can have a look in terms of the premiums. So if this is years, when if you're going through licensing, bill and startup, or licensing, bill and operation, all you have is business premium in the beginning. Okay, there's nothing but business premium. You haven't started, you haven't built, you haven't got any implementation risk yet. Okay, once you start building, and some heavy industrial projects or capital intensive or infrastructure projects may last 10 years to build. So once you start building, you've got business premium, liquidity premium, and country premium. Once you start up, that goes right down. This is one of the events. that I was mentioning. So you start up, that's an event. Everything's working, no more implementation risk, that's gone. No more operational risks. You've gone into operation, it runs smoothly. So you get rid of some basic risks very quickly, okay? So you're left with business premium plus your liquidity premium plus your country risk premium, which never leave, really. The liquidity premium may have variances depending on other things, other factors, but certainly your country premium will stay the same. Well, that's not true actually. Your country premium may not stay the same. That's just assuming it does, but it may vary. The country where the unit operates may, the country risk may be higher, lower. So even that has an impact. So if you want to exit, you should always go for the point where the risk is lowest, right? So because that's everything else being equal, your highest NPV. So I've done projects where the exit is, I target the exit to the point of lowest capital costs, including cost of equity plus the debt costs or refinance costs. So that's if you want to make money for your company, or if you consult to companies, you should, in my view, you should think about, okay, where do I go? How do I come in? How do I exit? How do the shareholders make money? How do the investors make money? Okay, and all else being equal, it should be at the point of lowest risk. Okay, so that's it. And conclusion. And so, what are the ingredients of a successful industrial project decision making? Capital budgeting process. Okay, which is ROI, break-even, payback, NPV, and IRR. Operational logic, investment logic, and obviously the capital structure. Okay, then you go into a go no go decision, which is a management decision. Okay, it's not just numbers, but you typically go to a design freeze. So you lock the project, you freeze the design, the financial design, and then you go into operation. Okay, so thank you very much. So back to the initial statements. Have you changed your minds about some of these statements? What about investors can make more money in digital economy than in heavy industry? Fact or fiction? So if you invest in a software company or an ICT company, will you tend to make more money than you invest in a furniture factory, industrial unit? What do you think? It's true.
They can make more money in digital economy.
They can make more money in the?
It's fact, this thing.
It's a fact.
Because the way it's the sentences.
Exactly. The word can means it's possible.
So I'm sure you've passed some legal training sometime, but yes, it's okay. Statistics from the.
But by definition of the way you've written these sentences, the point is that we disagree with them.
Well.
But
the
point is that you can, technically, it is possible for you to earn more money in the digital economy than heavy industry. However, you've proved the point that it's not as clear cut as some people might have.
Yes. There are you can make as much money in heavy industry and all style sort of economic sectors. You can make as much money. You just need to look at the specific dynamics or some of the dynamics behind the capital-intensive sectors. So, if you do that, it's fine. I've designed projects, very heavy capex, with rates of return of 30%, 40%, but it's all fine-tuned to get to those rates. Okay, so if you take into account the dynamics, you can make as much money as anyone else, with lower risk, by the way, because some of these projects are all either they have an off-taker, so you know who you're selling to. You haven't got any risk of not selling Some of these projects, the energy projects and infrastructure, you'll have either the government, as in central government, local government, or a big utility as your client. Okay, so most of the credit finance that I do is geared towards government guaranteed projects. So there's no risk. Okay, it's local government mainly. Anyone here from Vodafone? No. Okay, good. So the utilities such as Vodafone, Scottish Power, they're the clients in some of the projects, the infrastructure projects. So hardly any risk. So obviously some of these statements are not do not have a yes or no, but there isn't a yes or no answer. There's always a maybe, if this happens, yes, maybe you can, So I think that's the. As a target for today, my target was to raise awareness of industrial sector, which is something that I like to do, and also to bring to your attention that if you are, if you're interested, and if you look at detail, if you look at specific details, very minute, sometimes financial, sometimes business and financial. So outside of operations, outside of whatever you do, just the financial, it's so rich and so it's complex, but then not many people are doing this. So if you do spend the time, if you invest the time and the interest, you will come up with some unique competitive advantages for your own companies. So I think that's a point that although just I think 2 or 3 people in heavy industry, but this is applicable to any business. Okay. Thank you very much. If you wanna follow us on Twitter, the Twitter is Business Mathematics, and there's a LinkedIn group called Business Mathematics Made Simple. And if you want this presentation, just let me know and I'll give it to you. Okay? Good. Thank you. Thank you. Did I answer your question?
Of course.